What's the Risk? Hosted by myself, Daniel Crowe, and Peter Mansell, founder of Mansell Financial Group, a financial advice business he founded in 1980. This episode is on a few realities around the recent volatility we've seen, and that appears to have stemmed from the US placing tariffs on different countries. And we're going to tie that in with how investors may react and behave to the news, along with their portfolio and superannuation moving around. So, Your Investment Philosophy, a book we wrote, it's available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Don't make us tap the sign. Now, we put this up every video, and the key point here for this video is in the bottom right corner. The optimal portfolio isn't always the one with the highest return. It's the one that you can stick with. So that's going to form part of what we're talking about in this video.
Daniel, if I can just add one reinforcing point to that, over 4.5 decades, the worst results that I've seen clients experience have been when they have not been able to stick with the portfolios that they had. The changes driven by emotion during times of market volatility have been the single worst contributor for investments in the 45 years that I've been doing this.
So first up, tune out the noise. This sort of stuff, financial fear porn, the market can go up 20% in 6 months and you'll barely hear a word of it. But as soon as it's down, this is sometimes the first story, second story, third story on the news. It's in the newspapers, it's on the first thing in the radio, it's all over the internet. You've got to tune this stuff out.
Absolutely. Listening to the media in times of volatility, downward volatility, is one of the worst things investors can do, especially if they allow their mind to take much notice of the silly short-term comments that are made. I was looking at a client portfolio only yesterday, where at the beginning of January, very affluent client with a portfolio of just over $8.1 million. And in that time, in the last 8-9 weeks, they've actually spent $600,000 on a property change purchase, and their portfolio today was $7.4 million. The gains that had been made before the recent falls meant that despite all the recent hoo-ha, their portfolio is actually down all of $100,000, and it's an 85-15 portfolio mix, so 85% invested in stocks, and the net effect from January to now, including what they've withdrawn for their property purchase, is effectively about minus 1.25%. Hardly worth a headline, but obviously there are lots of headlines around at the moment.
Moving on to the next one. So intra-year declines versus annual returns. And the reality is the market does go down. Corrections and declines happen. They may not show up when you're looking at a periodic performance table and deciding on your super allocation or what ETFs to use, but it's definitely in there. And you can redraw this chart for the S&P 500. I've seen another one out very similar. And on average, you're just getting a double-digit correction every year.
Absolutely. And we've seen them so frequently. Like the last one's only October of 2024. So it's not even 6 months ago. The markets got jittery when it looked like Trump was going to win. Then he did win, and everybody got excited that here's this, low regulation, pro-business president. And then he comes out and does crazy things with tariffs, and the market suddenly gets scared. This is not abnormal, what we're experiencing now. It's extremely normal.
And what ultimately determines your performance? So when you build your portfolio, you're probably firstly worrying about fees and, agonizing over saving that three basis points between VAS and A200 and what ETFs will perform the best. But at the end of the day, none of that matters if you can't control yourself.
As I alluded to earlier, the single worst outcomes that I've observed over 45 years with many, many clients, the really bad results happen when panic sets in and a good strategy is thrown out, only for them to want to come back later when they've missed the boat. The inability to manage your emotions and the inability to stay disciplined is without doubt going to be investors' worst nemesis.
And what happens when you can't manage your emotions? And what you're saying there, you get a behavior gap between what the market returns and what your return is. This is the Dalbar report, and it shows the return for the average equity investor and the return for the S&P 500 going back 30 years. And there's also a similar study by Morningstar called Mind the Gap, and the average difference, they say, is probably around about 1%. So not as quite as pronounced as what Dalbar is showing, but The largest difference there is with sector equities. So something like the NASDAQ, which is very volatile, something that investors struggle to capture the full returns with because they just get thrown out on every correction and movement.
This is a great portrayal of the way in which emotional behaviour by investors and the inability to stay disciplined means that they don't even get the return that's there and available to investors for doing nothing. The orange bars were available to US investors in the S&P 500 or indeed global investors who would access the S&P 500 for doing nothing. And yet the end result of all the activity, the media analysis, the researching that's done, the decision making that's chewed over, and what do we get? The blue bars. It actually validates that there's an awful lot of humans that invest that are actually not very good at it, and it's largely because they can't control their emotions.
Probably another piece of evidence backing this up, a real life example from Australian super during the GFC. And in the lead up to the market bottoming in March 2009, the number of member switches to conservative options spiked. And you can see there, like 3,000 people went conservative around the week of the market bottoming.
Yeah, look, this is a familiar story to me. I've seen other materials of this nature over multiple decades, but this is a great indicator of real life where investors' emotions got the better of them and they did the worst thing at almost exactly the worst possible time. Those that switched to conservative and missed the run up on the other side of the V in the orange line there, that loss is locked in forever. You just don't ever get that back. But I've got a couple of classics of long-term clients whose emotions got the better of them at the worst of times, and we've been able to help guide them as best we could subsequently, but in each case cost themselves hundreds of thousands of dollars, and there's not a thing we can do about it now. That is permanent.
So how does an investor manage their emotions and behavior? And there's really three options. If you want to be 100% equities, then you need to just harden up. And there's a quote there from the Tom Cruise movie Collateral. You got to make the best of it, improvise, adapt the environment. Darwin, it happens. I Ching, whatever, man, we got to roll with it. So you've just got to harden up. If you can't do that, then you need to reassess your risk tolerance. And
absolutely, and you should too. At the end of the day, someone that wants to invest any amount of money, 100% in stocks, has to be willing to accept the good with the bad. I was speaking with a couple of young people yesterday, brother and sister, who have actually just inherited a six-figure sum each, and they were interested in investing in the stock market. And I portrayed to them in the baldest of fashions, in 1 year, their inheritance might go up 30 or 40 or even 50%, but it can also go down in 1 year by 30 or 40 or 50%. But if you want the long-term return from equities, if you go back to 1900, which is around 12% per annum, you've got to be willing to tolerate that on any 1 year, it might be minus 35, just the same as in any good year, it might be plus 35. You can't have the higher long-term average unless you're willing to take the bad along with the good.
probably 1.2. Most investors will be constructing their portfolio in times of plenty. They're feeling good and everyone wants to be a high risk investor when the market is up 20%. No one's expecting falls. I don't think anyone probably thinks about it as much when there's a correction happening. They see the returns, okay, I should get into ETFs and maybe change my super. So you're not expecting falls when you're probably constructing the portfolio. And you really need to ask yourself, how did you come up with this portfolio, this construction? And were you gassed up by your friends, your family, people on the internet? And a correction is a good wake-up call to understand risk.
Absolutely. And so your portfolio construction should be wholly and solely designed around your longer term financial needs, your personal lifestyle goals. And if your portfolio has been designed correctly, aligned to those things, you'll be fine. You don't need to worry about the volatility. You don't need to worry about the corrections. If your plan is still working, the short-term volatility that we've seen of late is just another one of those events. At some point shortly, that will cease and we'll move back to positive returns and people will get comfortable and relaxed again. Investors that are well schooled by their advisor in long-term relationships they don't panic. In the last 3 weeks, our firm, which looks after around 800 families, have been taking zero phone calls. And some of the falls, on a daily basis have been quite pronounced, and the media's obviously been active promoting that, but we have not taken a solitary phone call.
So the final point there, advice can help. And a lot of advice is behavior management, reminding investors these things happen and temporary market decline is not permanent capital loss. So it's ensuring that there's not the gap in returns we saw in that Dalbar slide between the investor and what's freely available. And while you have mentioned a couple of stories of clients getting to the point where they feel they have to sell, but that's the extreme minority, and 99.9% of clients don't do anything. And when there are concerns, it's been their advisor keeping them in their seat and ensuring they don't jump out at the worst possible time.
Absolutely. Look, the two instances I referred to a minute or two ago, one was back in the global financial crisis. At that time, they and one other client of another advisor in our firm did bail out, at the wrong time, but every other client stayed in their seat. The second of the examples that I was referring to were husband and wife that were doctors when COVID hit, and somehow they managed in their minds to construe that because there was a pandemic that involved an illness that we had not dealt with before, that was going to mean that the Western democratic economies were going to fail. Look, the COVID experience was damn scary, but it didn't melt down the Western developed economies, but they felt for sure that's what would happen, and they've paid a price for it.
Well, with that level of expertise around medical matters, you would probably it would be hard to convince them otherwise if they had that in their minds.
Despite my best efforts, I certainly couldn't convince them. I was of the view that we've had many a shock before. If you go right back through the 20th century and into the 21st century, when you look at events like World War I, the Great Depression, World War II, September 11, the global financial crisis, the OPEC oil crisis of the 1970s, there's an awful lot of events that happen with very little notice that drive markets down, that drive fear and panic, but they end. And the world goes back to Western democratic free market economies that have a level of success that prevails in the long term. We just have to be patient.
Again, is your portfolio for you? Do you have the discipline to stick with 100% stock allocation? And just that reminder, the optimal portfolio isn't always the one with the highest return. It's the one that you can stick with.
Absolutely. Couldn't agree more.
And sources and descriptions of data. Thanks for your time.
All right. Thanks, everyone.